Welcome to our digitalized taxpayers briefing and orientation. I will be discussing the provisions of Republic Act 11534 or the Corporate Recovery and Tax Incentives for Enterprise or the CREATE Act on the implementation of the new final tax rates on certain passive income pursuant to Revenue Regulation 2-2021. A tax of 20% is hereby imposed on certain passive income from all sources within the Philippines. Income payments to resident foreign corporation. Number 1, tax on branch remittances, 15%. Number 2, interest on any currency bank deposits and yield, 20%. Next, interest income derived from a depository bank under the expanded foreign currency deposit system, 15%. On capital gains from sale of shares of stocks not traded in the stock exchange, 15%. On income derived from all sources within the Philippines by a non-resident foreign corporation, in general, the rate is 25% starting January 1, 2021 onwards. On dividends received from a domestic corporation, the rate is 25% in general. However, a reduced rate of 15% shall be applied subject to the condition that the country in which the non-resident foreign corporation is domiciled shall allow a credit against the tax due from the said non-resident corporation equal to 10%, or does not impose income tax on dividends received from a domestic corporation. Lastly, on capital gains from sale of shares of stocks not traded in the stock exchange, 15%. Government money payments. Government money payments shall be subject to 1% withholding tax for the period July 1, 2020 until June 30, 2023. Transitory provisions. Any taxes withheld where the withholding agent uses the higher rate may be claimed as tax refund by the withholding agent if the taxes withheld have already been remitted. Another topic is the implementation of the new items of VAT exemption and the reduction of percentage rate under the CREATE Act pursuant to Revenue Regulation 4-2021. There are 3 items of VAT exemptions. Number 1, sale, importation, and publication of digital and electronic formats of books, any newspapers, magazines, journals, review bulletins, and educational reading materials covered by the UNESCO Agreement. This VAT exemption begins upon the effectivity of the CREATE on April 11, 2021. The second item of VAT exemptions is the sale or importation of prescription drugs and medicines for diabetes, high cholesterol, hypertension, cancer, mental illness, tuberculosis, and kidney diseases. The requirements to warrant this VAT exemption are flashed on your screen. Take note that the VAT exemptions on medicines for diabetes, high cholesterol, and hypertension is effective January 1, 2020 onwards, while the VAT exemptions on medicines for cancer, mental illness, tuberculosis, and kidney diseases is effective January 1, 2021 onwards. The third and last item of the VAT exemption is the sale or importation of capital equipment, spare parts, and raw materials for the production of personal protective equipment or PPE components. Sale or importation of drugs, vaccines, and medical services for the treatment of COVID-19, including raw materials directly necessary for the production of drugs for the treatment of COVID-19. These are the temporary COVID-19 measures and is effective January 1, 2021 until December 31, 2023 or for a 3-year period. Take note, what is VAT exempt is the sale or importation of capital equipment, spare parts, and raw materials for the production of personal protective equipment or PPE components. Thus, the sale or importation of finished PPEs is subject to VAT, unless they are VAT exempt pursuant to other provisions of the tax code. The CREATE Act reiterates the 3 million VAT threshold. However, there is a decrease in the percentage tax rate from 3% to 1% effective July 1, 2020 until June 30, 2023 or for a 3-year period. This applies to any person whose sales or receipts are VAT exempt under Section 1091(c) of the tax code, or those falling under the 3 million VAT threshold and is not a VAT registered. Transitory provisions. The taxpayer shall treat the resulting excess taxes paid due to the inclusion in the items exempt from VAT in the following manner. Number 1. The unutilized VAT paid on local purchases or importation may be carried forward to the next taxable quarters or be charged as part of the cost. Number 2. The excess payments as a result of the decrease of tax rate from 3% to 1% starting July 1, 2020 until the effectivity of these regulations may be carried forward to succeeding taxable quarters. And third, the excess or unutilized input taxes as a result of the change of status from VAT to non-VAT registration may be applied for refund or issuance of tax credit certificate at the option of the taxpayer. That ends our discussion on the CREATE Act. Thank you for listening.